Assalamualaikum warahmatullahi wabarakatuh. We are from Group BA 2424B and we want to present about Mudharabah. Before we start, I would like to introduce my teammate. Myself is Nur Aisyah binti Ahmad Razali. My second teammate is Nur Liana Akmal binti Muhammad Zaki. And my third teammate is Nur Aira Balkis binti Muhammad Zamri.
Contribute effort in the form of managerial skills, mudarrib or manager. Muqarradah and kirad are also synonymous with mudharabah. Profit from the outcome of the venture is shared between the capital provider and manager according to mutually agreed profit sharing ratio, while losses are borne solely by the capital provider. Provided such loss is not due to the manager's negligence or violation of specific conditions. In other words, mudharabah is a joint venture where one party contributes capital while the other contributes managerial skills. In the context of business and trade, it means a joint enterprise in which all the partners shares the profit according to a mutually agreed profit sharing ratio, but losses is borne solely by the capital provider or investor. The technical definition is adopted from the purpose of this parameter. The legitimacy of the mudharabah contract is found on the basis of the Quranic verses, the Sunnah of the Prophet Muhammad SAW, and the consensus of Muslim jurists, ijma'. There are 5 features of mudharabah contract. First, nature of mudharabah contract. In general, the contract of mudharabah allows any one of the contracting parties to terminate the contract unilaterally. The contract shall not be terminated unilaterally if the manager has commenced the work or when both parties have agreed not to terminate the contract during a specific time. Second, capital. Capital is the principal feature of mudharabah, forming the substance of the contract. The capital shall be contributed by the capital provider only. The capital shall be managed by the manager to generate income. The capital of mudharabah may be in the form of monetary or non-monetary assets. Monetary assets of different currencies shall be valued according to an agreed currency at the time of signing the mudharabah contract. Capital in the form of non-monetary asset, which may include intangible asset, should be valued based on the valuation determined by a third party. Third, management of mudharabah venture. All work and activities undertaken by the manager in relation to mudharabah capital shall be Sharia compliant. The manager shall have the exclusive right to manage the mudharabah venture. The capital provider shall be precluded from managing the venture. However, the capital provider has the right to information regarding the conduct of the manager. The managers shall not be liable for any loss of capital unless such loss is due to the manager's negligence, dishonesty, misconduct, or breach of the term of the contract. Fourth, profit sharing rights. Profit sharing is the primary motive of the mudharabah contract. Profit shall be based on revenue after deducting all operating costs of the venture and taxes. The profit sharing may be based on a ratio or percentage to be agreed upon by all partners. The profit sharing ratio shall be determined at the time of the conclusion of contract and may be revised from time to time during the contract subject to mutual agreement. Fifth, loss liabilities. Loss shall be recognized when the liability exceeds the value of the asset at a point in the time from a balance sheet perspective. Alternatively, when expenses exceed revenue for a defined period, an operation loss shall be recorded. Mudharabah operating loss, which is measured during the operating period, may be offset against prior or future profits. Loss shall be solely borne by the capital provider except in the event of misconduct, negligence, or breach of contract by the manager. The manager may not undertake to bear the loss. The manager may bear the loss at the time the loss is realized without any prior condition or undertaking. Let's move to value proposition of Islamic finance. Mudharabah is a form of Islamic equity-based partnership contract, commonly known as a profit-sharing contract. It is a partnership contract where the capital provider contributes the capital, while the manager provides managerial skills to manage the Mudharabah capital accordingly. In practice, the Mudharabah contract could be categorized into unrestrictive or general and restrictive or specific of Mudharabah contract. The parties involved in a Mudharabah contract share the profit between them. However, the loss will be borne solely by the capital provider in the absence of misconduct, negligence, or breach of the partnership term and condition by the manager. Hence, the element of trust based on the fiduciary relationship between the parties is the foundation of this contract. The significant application of a Mudharabah contract could be achieved in the combination of financial and managerial resources between the parties. Mudharabah is functionally adaptive in the area of general or specific investment, project financing, bridge financing, working capital and SME financing, interbank investment, structured products, investment deposits, and others. The capital as wealth entrusted to the manager promote mutual goodwill among the partners and channels wealth to productive use. The manager in the position of trustee should act in full integrity and is expected to perform in the best manner to achieve the desired aim of the capital provider who has invested his capital without having any control in the management of the venture.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Aisyah binti Ahmad Razali and I will continue the presentation. So I will present about 1.4, which is the transaction of Mudharabah. Profit is shared both parties according to the predetermined profit sharing ratio. The profit sharing ratio has been mutually consented and explicitly stated at the time of contracting and has to be a proportion of the profit. And the payment of the profits to the financier cannot be in the form of a fixed amount or any percentage of the capital employed. Furthermore, the earned profit cannot be distributed until all the expenses have been paid in according to the custom and the original agreement. Okay, next we go to the type of Mudharabah. There are two types of Mudharabah, which is Al-Mudharabah Al-Muqayyadah, which known as restricted Mudharabah, and another one is Al-Mudharabah Al-Mutlaqah, which known as unrestricted Mudharabah. For restricted Mudharabah, which is Al-Muqayyadah, Robber Ma'al may specify a particular business or a particular place for the mudarib, in which case he shall invest the money in the particular business or place. This is called Al-Mudharabah Al-Muqayyadah. Okay, for unrestricted Mudharabah, which known as Al-Mudharabah Al-Mutlaqah, They said that, however, if Rabbul Ma'al give full freedom to Mudarib to undertake whatever business he deem, this is called Al-Mudharabah Al-Mutlaqah. Okay. For example, however, Mudarib cannot, without the consent of Rabbul Ma'al, lend money to anyone. Mudarib is authorized to do anything which is normally done in the course of business. However, if they want to have an extraordinary work, which is beyond to the normal routine of the traders, he cannot do so without express permission from Rabbul Ma'al. He is also not authorized to keep another mudarib or a partner and mix his own investment in the particular mudarabah without the consent of Rabbul Ma'al. Okay, now we look roles of mudarib. First of all, what is mudarib? Okay, in Islamic finance, mudarib is the entrepreneurial partner in a mudarabah partnership who provide the expertise and management. It is equivalent of general partner in Western model partnership. Okay, first role of mudarib is amin, which is truster, to look after the investment responsibility except in case of natural calamities. Okay, second one is wakil. Wakil is known as agent, which is to purchase from the funds provided by Rabbul Ma'al. Okay, third is sharik, which is partner. They sharing in any profit. Okay, fourth is zamin, which is a liable to provide for loss suffered by the mudarabah due to any act on his part. And the last one is ajir, which is known as employee. When the mudarabah gets fasid due to any reason, the mudarib is entitled to only the salary, ujrat imisli. In case there is a loss, the mudarib will not even get the ujrat misl. Okay, before we go further, my teammates will explain about the differentiation between the Islamic banking and the conventional banking. But before that, I will make a simple explanation about why we choose conventional and why we choose Islamic. Okay, first of all, why we choose conventional is four reasons. Okay, which is they are more transparent, there is a better organization, but no halal requirement, less paperwork involved. Okay. But why we need to choose Islamic? Okay, there are several reasons and several advantages when we choose Islamic. There are also four reasons. First is no interest will be charged, government discount, shared risk with the bank, and the last one is for Muslim and non-Muslim. Okay, so next we go to 1.6, which is the operating mechanism of Islamic banking and finance. Okay, in fund utilization, they are the process of using the funds realized in Sharia compliant business. There are three types of mechanism, which is sharing modes, sales modes, and leasing modes. Okay, what is sharing mode? Sharing mode is tell about the partnership where funds initially mobilized invested in a Sharia compliant business. Parties share profits and loss. Okay, in sales mode, the bank purchase an item on behalf of the client and sells it them on the deferred basis or immediately. In the leasing mode, the rent of an asset or hire purchase where a rental fee is paid for a stipulated period of time mutually agreed by the parties.
Profit and loss sharing is a fundamental concept and ideal principle to build an Islamic financial instrument for Islamic banking and finance. Profit and loss sharing is the method utilized in Islamic banking and finance to comply with the prohibition of interest. The idea suggests fair sharing of risks and profits between the parties involved in a financial transaction. In the banking business, Islamic financial institution as financial intermediary applies this principle as the main tool to fund mobilization. As it is partnership contract between the institution and its depositor, or we call as investor, on one hand, and sign partnership contract between the institution and its borrower on the other. Since the relation between them is partner, so the financial institutions will not receive a fixed rate of interest on their outstanding loans, but they will share in profits or in losses of the business of whom they have provided the funds. In the same fashion, those who deposit their funds in an Islamic financial institution will share in the profit or loss of the financial institution itself. In this way, Islamic financial institutions provide savers and investors or borrowers with investment instrument that is similar to equity that named as MUDHARABAH. MUDHARABAH is a profit and loss sharing contract which one party is known as Rab al-Mal, or we call as financier, which is they provide all the capital needed for financing the project, and on the other hand, the other party is known as Mudarrib, or we call as an agent, which is the provide labor and effort. In this contract, proportionate share in profit is predetermined by mutual consent between two parties. But in case of loss, only Rab al-Mal, or we call as financier, bears the capital loss, and Mudarrib loss by getting in return for his expended time, effort, and labor. So Hanafi school jurisprudence distinguish Mudharabah contract into two types, with regarding to the agent's activities, restricted and unrestricted Mudharabah. Okay, so as the graphic shown, we can see that it has a lot of going on. So I would like to elaborate one by one. So first is bank and client discuss a business plan, and which is bank will provide funds to client towards capital investment. Second, client set up the business and manage its operations. Third, business generate positive or negative profits. So fourth, profits if positive, they are shared between client and banks as per agreed ratio. And lastly, if profits if negative, if the profits is negative, they are absorbed by bank and effectively bringing down the value of the asset created with its investment. In capital market, Mudharabah are applied to provide equity-based financing product as trustee partnership by partnership facility by financial institution, as Rab al-Mal, financial institution provide capital to customer or business enterprise. So the customer or the business enterprise act as a Mudarrib, who is responsible for management of business project. Islamic funds are also typically built under a two-tier Mudharabah structure, although at present most of funds in the markets are available only for big amount of capital investor, generally requiring at least 100,000 US dollars of investment money. However, smaller minimum amount could be offered in the near future in response to the growth of Islamic financial markets. Last but not least, I would like to explain about the comparison between conventional banking and Islamic banking. So, let's see how we identify conventional and Islamic banking. So first, conventional they are not deal with zakat. So, but as for Islamic banking, nowadays in a modern way, it has become one of the service-oriented function of the Islamic banks to be a zakat collection center, and they also pay out their zakat. Number two, for conventional banking, it can charge additional money in case of defaulters, but for Islamic banking, they have no provision to charge any extra money from the defaulters. Third, conventional bank has to guarantee all its deposits, but Islamic bank can only guarantee deposit for a deposit account. The depositors are guaranteed repayment of their fund. Fourth is the status of a conventional bank in relation to its client is that of creditor and debtors. We call as creditors and debtors. But as for Islamic bank, in relation to its client is that of partners, investors and traders, buyers and sellers. Okay, so that is the term between relation to their client lah. So last but not least is conventional bank. It is very often a result in the bank's own interest becoming prominent. So it makes no effort to ensure growth with equity. But as you can see for the Islamic banking, it gives due to importance to the public interest. Its ultimate aim is to ensure growth with equity. So I hope with that you all of you able to identify how to differentiate between conventional and Islamic banking. So
That's all from us. Thank you.